Hi, everybody. This is Laurens Bensdorp from Trading Mastery School. And in this video, I'm going to show to you a complete rule-based automated S&P 500 long-term trend following system. All the rules will be revealed, so you will have some clear steps of how a complete trading system actually looks like. Now, this will be a simulation from 1995 to 2021. And let's get to it. Let's get to the PowerPoint presentation. So I'm going to share my screen over here. There we are. So this is a simple S&P 500 trend following system. And it outperforms the S&P 500 with 6% more annual returns and has a lot lower drawdowns. So the simulation resulted into a 14% compounded annual growth rate, slippage and commission included. I did not include dividends. So if you would have gotten some dividend, that is not included in the compounded annual growth rate. I like to keep it conservative. So it is a system that is very low maintenance. It's easy to execute. And the simulation turned 100K into 3.3 million since 1995. And compare that to the S&P 500 that turned into less than 1 million. And what you see is that 6% more annual return, how much the power of compounding is helping you there. So all rules will be reviewed at the end of this video. So let's go to the next page. As always, with every system, it is incredibly important that we have an objective for the system. Objectives is probably the key thing for every kind of trading system. You need to know what you want to achieve. And in this system, it's clearly to outperform the S&P 500 with larger returns, but less risk. And to make big double-digit returns in bull markets and try not to give back too much money in sideways markets. Generally, a trend-following system in sideways markets is not doing all that good, of course, because it's getting kind of choppy and everything. And also, the negative part is we expect to not make money in bear markets. I mean, when the market goes down, a long-term trend following system is not going to make you any money. And that is something, as long as you understand that and respect that, then you will be able to actually trade a system like this as well. So here's the equity curve of the system, and we see the green line, which is the equity curve of the system that we have developed. And we clearly see that there's a nice and great outperformance during the beginning from 1995. It kind of was on the same level. It then kind of skyrocketed, what happens very often during that big dot-com bull market. And you also see that afterwards it had a drawdown as well. And you see that actually the drawdown, for my taste, was a little bit too big because it was around 40%. So that's generally not that desirable. And what I do in my own trading, I trade then at the same time a short selling system with that as well to offset that drawdown. Now, if we see the second drawdown over here in 2008, where the S&P 500 lost about 35% for the year, and the maximum drawdown of the S&P 500 was 56%. You see over here, it just went down to 20%, and then it got flat because all the positions were stopped out and you basically had no work to do anymore. And after that, it resumed it again. And you see that in times of COVID, where it dropped, of course, but it fairly fast recovered again to making some money. So here we see the monthly and the yearly returns, and we see, of course, that from 1995, it did incredibly well. It was very easy times to make money at that time. There was good volatility in the markets and everything, and so that was very easy. But you also see when the bear market then came in 2000, that the system was just losing money. And that is so important to understand that that is exactly what you can expect as well from a trend following system. When the market starts to go down, the stocks go down, and you start to lose money. So fairly normal. It then resumed very well. Wasn't that great over here, but did fairly well. So in 2008, you see all these zeros over here, where basically where the markets continued to drop like a stone, this system was just completely out of the market. So it only lost therefore 11% in 2008 versus I think 34% of the S&P 500. And after that, it kind of resumed again. And you see afterwards here that there's very nice yearly simulated returns. You see, of course, that during the COVID period, or a little bit of the pre-COVID as well, that it started to lose money as well. After that, it kind of went flat in April. And after that, it started to resume to make money. And this year, it kind of doesn't go anywhere. But all in all, you have a system that did quite well. So if we take a look at the rules. So as I mentioned, this is a system where we only trade S&P 500 stocks. And the first thing we want to look at is liquidity. We only want to trade very liquid stock. So in this case, the rule for the liquidity is that the average daily dollar volume over the last 20 days is more than 50 million shares. Now, it's important to understand that there is no magic to that number. It's not that 40 million is better or 30 million is better, 60 million or that 30-day look back. No, I chose this number randomly. I just wanted to have it a lot of liquidity. If you have a very small account, you can certainly trade stocks that are a lot less liquid and you get more opportunity for that. But this is totally fine, but there's no magic to this. So let's go to the entries. And my idea was to keep this as simple as possible. So the first rule is that the close of the SPY, which is the ETF of the S&P 500, needs to be above the 50-day simple moving average plus 2 average true range over the last 20 days. So we want the overall index to be up, and we measure that by the fact that the close is above the 50-day moving average, but also a band a little bit higher of 2 average true range. Then the next rule, the close of the stock is the highest close of the last 50 days. Kind of a Donchian channel, very simple trend following rule, but it just says that it is the highest close over the last 50 trading days, which means that the stock is trending up, which for us is a clear sign. Okay, we're trading trend following, so we want to be in here. So we trade a maximum of 10 positions. So we can never place more than 10 orders. And if we already have 5 positions open, then we only can place 5 more orders. So we can never have more than 10 positions. And the position sizing algorithm here is that we use a 2% risk of our equity with a maximum of 10% of the size of the equity. And if you want to know more of that position sizing, I don't want to go into that too deeply. It's written in the two books that I have written, The 30-Minute Stock Trader and Automated Trading Systems. So then, of course, with rules like these, and there's a big trending market, there are times where we will have more candidates than our money manager allows us to trade. So in that case, if we have more candidates, then we rank the order by the highest rate of change of the last 50 days. So we take a look, let's say that we can only trade 10 stocks, but we have 50 candidates. So we need to prioritize then, and we say, okay, we trade then the 10 stocks that had the highest percentile increase over the last 50 days. Then we have that list of stocks. And then the next day we buy market on open. Exit rules: at the evening or before the next day's market on open, we take a look at our position and we need to place an initial stop loss for the stocks that have been executed. And what we do is we have an initial stop loss of 5 average true range below the execution price. So that means that we get stopped out when it starts to go against us, and there comes a time where we say we need to protect our initial capital. So if it gets stopped out at 5 average true range, the maximum that you can lose is 2% of your equity, because remember, the position sizing that we use here is that we risk 2% of our equity. Another benefit as well is that with a 5 average true range, if we use the average true range, we use the volatility of the stock as well. So with a very volatile stock, we will have a wider stop loss. And if the stock is not volatile at all, it will be a smaller stop loss. That's the way how we treat every stock the same as far as the volatility. Now, once the stock starts to actually be in positive territory, we will be having a trailing stop of 17.5%. Again, there's no magic to these numbers. You can have 4 average true range as well. You can have a 20% trailing stop. The whole thing over here is that what you want is you want to cut your losses when it's not going in your favor, and you want to continue to ride the trends when the stock is moving actually up. So we just continue to trail that. And as I mentioned, this is what you get then eventually, a 14% compounded annual growth rate. And we had here a bit more than a 40% maximum drawdown. Highly recommended to trade a system like this together with a short selling system, so you can set off the losses that you have over there, because the drawdown duration is quite long as well over here. But you see, it did a great job as well protecting you from events like in 2008, where the drawdown of the S&P 500 was a lot larger. And this is a good start if you just want to have a simple system that is easy to execute. So thank you very much for watching. And if you want to know more about the things I do, just go to tradingmasteryschool.com or just click on the link below this video. Thanks a lot for watching. Bye-bye.